There is a 5-year window in your financial life that most people never take advantage of. It opens around age 60. It closes at 65, when Medicare starts. Inside that window, the tax math lines up in your favor in a way it never will again. Before this window, you are still working. Your income is too high. Conversions would push you into expensive brackets. After this window, Medicare starts. IRMAA kicks in. Required minimum distributions follow. The IRS starts forcing money out of your accounts. But during this window, your income drops after retirement. Tax brackets open up. IRMAA has not started yet. You control exactly how much you take and when. And every dollar you convert during this window comes out tax-free for the rest of your life. Every single dollar. If you are between 55 and 70 right now, this video is the most important retirement planning content you will watch this year. Before we get into the strategy, let me make sure we are working from the same foundation. Traditional IRA and 401k, you contribute pre-tax money. It grows tax-deferred. You pay taxes when you withdraw. The government forces you to withdraw starting at age 73 through required minimum distributions. Roth IRA, you contribute after-tax money. It grows completely tax-free. You pay zero taxes on qualified withdrawals. No required minimum distributions during your lifetime, ever. A Roth conversion is when you move money from a traditional IRA or 401k into a Roth IRA. You pay income tax on the converted amount in the year of the conversion. In exchange, that money and all future growth comes out completely tax-free. No RMDs, no IRMAA exposure, no taxation at any future withdrawal. That is the trade. Pay taxes now, at known rates. Never pay taxes on that money again. The question is not whether Roth conversions are a good idea. For most people with significant traditional IRA balances, they are. The question is when. And the answer, for almost everyone, is the window between age 60 and 65. Let me show you why this specific window is so valuable. Before the window, ages 50 to 59. Most people are in peak earning years. Salaries are at their highest. Contributions are maxed. But income is also at its highest, which means converting traditional IRA money to Roth means paying high marginal rates on every converted dollar. Converting $50,000 in a year where you are earning $200,000 means that $50,000 is taxed at 32% or more. The math usually does not favor large conversions here. The window, ages 60 to 65. You retire. Income drops sharply. You are no longer pulling a salary. Social Security has not started yet, or just started. RMDs have not started yet. Medicare has not started yet. Your taxable income may be the lowest it has been since your 30s. This creates massive space in the lower tax brackets. The 12% bracket for a married couple in 2026 applies up to about $94,300. The 22% bracket runs to about $201,050. If your only income is modest withdrawals and maybe a pension or early Social Security, you may be able to convert $60,000 or $80,000 per year and stay entirely within the 22% bracket. After 65, the window closes. Medicare starts at 65. IRMAA uses income from 2 years prior. Any large Roth conversion today affects your Medicare premiums 2 years from now. At 73, RMDs begin. The IRS forces taxable income out of your accounts, whether you need it or not. Those RMDs are layered on top of Medicare premiums, on top of Social Security, on top of any other income. The tax situation gets progressively more constrained. The window gets smaller, and eventually it closes. Let me show you this in real dollar terms. 2 people, both 60 years old. Both retire with $600,000 in a traditional IRA. Both plan to start Social Security at 67. Both live to 85. Person A does not use the conversion window, leaves the traditional IRA alone. At 73, RMDs begin. The account has grown to approximately $1.2 million. RMDs in year 1, roughly $44,000. By year 5, RMDs exceed $55,000 per year. All of it taxed as ordinary income. All of it counted toward IRMAA calculations. Social Security becomes 85% taxable. IRMAA surcharges begin. Over the retirement, hundreds of thousands of dollars go to income taxes and Medicare surcharges that could have been avoided. Person B uses the conversion window. Between ages 60 and 65, converts $80,000 per year into Roth. Total converted, $400,000 over 5 years. Tax bill on conversions at 22%, approximately $88,000. Traditional IRA balance at 73, roughly $300,000. RMDs are smaller, roughly $11,000 per year. IRMAA exposure is dramatically reduced. Social Security taxation is lower. Roth withdrawals are 0% tax, forever. The upfront tax cost, $88,000. The lifetime tax savings from lower RMDs, lower IRMAA, lower Social Security taxation, well over $200,000. The same money, two different strategies. One approach funds the IRS for decades, the other funds the retirement. This is the connection most people completely miss. Roth conversions and IRMAA are directly linked. We covered IRMAA in a previous video, the Medicare surcharge that kicks in when your income exceeds certain thresholds. In 2026, IRMAA starts at $109,000 for single filers and $218,000 for married couples filing jointly. Your IRMAA is calculated using your income from 2 years prior. Here is how Roth conversions reduce IRMAA for life. Every dollar in your traditional IRA that you convert to Roth before Medicare starts is a dollar that will never appear in your MAGI when you take it out in retirement. Qualified Roth withdrawals do not count toward income. They do not trigger IRMAA. They do not increase the taxable portion of Social Security. They do not push you into a higher tax bracket. Compare that to traditional IRA withdrawals, which count as ordinary income, which add to MAGI, which can push you over an IRMAA threshold and cost you hundreds of dollars per month in additional Medicare premiums. The Roth conversion window is not just a tax strategy. It is the foundation of a tax-efficient retirement. Here is the practical framework for executing the conversion window strategy. Step 1. Calculate your income floor. In the years between retirement and age 65, what income do you actually have? Pension income, part-time work, rental income, investment dividends, Social Security if you started early. That income, before any conversions, determines how much room you have in the lower tax brackets. Step 2. Identify your bracket ceiling for 2026. 12% bracket tops out at $94,300 for married filing jointly. 22% bracket tops out at $201,050 for married filing jointly. Subtract your income floor from those ceilings. The remaining space is your conversion room. If your income is $40,000 and you want to stay in the 22% bracket, you can convert up to $161,050 of traditional IRA money and stay at 22% or below. Step 3. Watch the IRMAA threshold. Remember, your 2025 and 2026 income affects your 2027 and 2028 Medicare premiums. The first IRMAA threshold for married couples, $218,000. Build your conversion plan to stay below this line. Going $1 over triggers the entire surcharge. Step 4. Convert annually, not all at once. The best Roth conversion strategy is disciplined annual conversions, not one massive conversion that creates a giant tax bill. Think of it as tax bracket filling. Each year, take your income floor, add your planned conversion amount. Verify the total stays below your chosen bracket ceiling and below the IRMAA threshold. Execute the conversion. Repeat for 5 years. Step 5. Use the right accounts to pay the tax. This is a detail that matters significantly. When you convert $80,000, you owe taxes on $80,000. If you pay those taxes from the converted amount, you are reducing the amount that ends up in Roth. That is not ideal. If you can pay the tax bill from a separate taxable account, the full $80,000 goes into Roth. The full $80,000 grows tax-free. The full $80,000 comes out tax-free. Paying conversion taxes from outside money is one of the highest leverage moves in this strategy. Step 6. Revisit the plan. Every year, tax brackets adjust for inflation. Your income changes. Market performance changes your account balances. Revisit the conversion amount annually. Do not set it and forget it. Let me be direct about who this strategy applies to. If you are in your 50s and still working, start planning now. Model what your income will look like in early retirement. The window is coming and preparation is what makes it work. If you are between 60 and 65 right now, this is your window. Every year you wait is a year of conversion opportunity lost. You do not need to convert everything, but doing nothing is a decision, just not a conscious one. If you are already on Medicare, the full window has passed, but partial conversions still make sense, just with IRMAA planning built in. Stay below the IRMAA tier thresholds. Model the 2-year look-back impact. Convert in smaller amounts in lower income years. If you are already taking RMDs, qualified charitable distributions are your primary tax reduction tool now. Consider them first before any conversion planning. If you have a large traditional IRA balance, over $500,000, $1 million or more, the RMD math at 73 will be substantial. The conversion window was designed for this situation. Every year you leave large pre-tax balances unconverted is a larger RMD problem building in the background. The Roth conversion window is not complicated. It is 5 years of disciplined annual conversions at a time when the tax math works in your favor. Before Medicare, before RMDs, before the rules make it harder every year. The people who use it retire with more money. Lower taxes, lower Medicare premiums, more flexibility, more freedom. The people who miss it spend 20 years writing checks to the IRS that they did not have to write. If this video helped you understand a strategy that nobody explained clearly before, hit that like button. Subscribe to this channel for plain English retirement education every single week. And for the free Social Security cheat sheet and our complete book series, visit retirementblueprintguide.com. Everything you need to build the retirement you actually want.